Yeah.
Hello, everyone. Thanks for joining in. Gary has been kind enough to take us through all the important data releases by the US last week. Gary, what do you think of where we are at the moment?
Yeah, it was interesting data, but it wasn't groundbreaking. I've got on the screen here to start with the PCE price deflator, um, which is something that the Fed tends to focus on because it's slower moving and it tends to show the underlying trend of inflation in the United States. And you can see that broadly the numbers came in line with expectations. So you've got a survey number and then the actual, if you look down those columns, and there's not much of a gap between those figures. So that was, in a sense, the good news, because the bad news would have been a number which was demonstrably stronger than expected. But I would also caution people a little bit. We do have the CPI number in about 10, 12 days from today, and that is probably going to have more weight on current sentiment than we see with these figures. The other thing in terms of the inflation news, though, is, and I'm scrolling up a little bit here, is what's called the University of Michigan survey. That's of consumers, of households. And what the Fed is very concerned at is that if expectations of inflation get anchored at high numbers. So there was good news in these figures. You'll see down there the University of Michigan 1 year inflation. That number was expected to be 5%. It came out at 4.8, and the 5 to 10 year inflation, which had been much higher. I mean, we were looking at numbers of 5, 6, 7, almost going back to the bad days of COVID. And we're now down at 3.5. Now, 4.8 and 3.5 are still a long way away from 2.5, 2.25, which is where the Fed would like these numbers to be. But it kind of takes away some of the urgency and therefore maybe gives a greater scope for them to be cutting interest rates at the next meeting.
Do you think that 2.5% inflation rate, that sweet spot, which typically the Fed has always been after, especially after the last Powell's last comments, it does seem that they may have broken away from that traditional target. What do you think of that?
Yeah, I think they're going to stay with the target, but I think they're going to be patient. If things are going well enough, i.e., a 4.8 or a 3.5 is not good news, right? But it's better than the 5 and 3.9 that we had last time round. So I think if the trend is down towards hopefully the target of the Fed, they're going to be more patient about monetary policy. And, for whatever reasons, they may indeed cut interest rates if they think there's weakness in the economy.
And what are your thoughts on China at the moment?
Yeah, I mean, it's interesting. We have a couple of comments. One is the very near term, and one is over the next couple of quarters. The equity market has done very well, but I would again explain to people there's a technicality in there. There's been a very vibrant Hong Kong market, and there's been a less vibrant onshore market. But when you take those numbers in aggregate over 12 months, you're looking at strong double-digit returns. Now, some of it is because China's actually done okay. Some of the data we came out with or seen from on GDP and on an underlying basis has been stronger than expected. And secondly, we still believe that the government has scope at the end of this year to be supportive of the economy. Now, that could come in providing looser monetary policy in its many forms, so encouraging borrowing, allowing banks a little bit more freedom to lend out. Or it could be in direct action, as we've seen before, of the Chinese government giving money almost to consumers to go out and buy white goods. So substantial discounts when people were buying products in the consumer area. And that allows for a bit of vibrancy in the consumer sector while they're still clearly unwinding the problems of the past, which were particularly focused on the real estate sector. Now, that's the kind of medium term. I think in the very, very near term, there's a lot of focus, and this is a bigger theme, which we won't dwell on too much today, but it's worth highlighting. It's this big, call it symposium coming up, which is largely the BRIC countries, but it's focused on Asia. And that, I think, when you're going to start to see the Putins, the Xi Jinpings, and the Modis standing together on a stage, with the millions and billions of people that they represent, that's going to put a shadow over what's happening in the United States today. And I passionately believe that these kind of countries are going to be the future. And the more that we talk about them and realize where the future is, the more that I think over even the near term, we could see more substantial gains away from US asset markets and into emerging countries.
Do you feel that emerging markets are going to experience a large wave of liquidity on the basis of potentially next week's symposium and just sort of an undervaluation of the sector? What are your thoughts on liquidity?
Yes, I mean, I think India's had its problems largely because people had assumed that it's kind of gone surprising growth, and it was just coming in line with expectations. But quite frankly, in the last few days, the GDP numbers were stronger than expected. But also there is a wave of movement, and it's kind of people realize that they've got too much dollar, and it goes back many decades to when Japan was at a very substantial weighting in the global equity markets. People kept saying it can't go much further, but it kept going, a bit like the way the US has done, until the day it doesn't. And I think we're now at that point where we've seen the maximum economic power of the United States, and as we go into the future, that power is going to be transferred to the east, and the capital flows will follow. So I think we're at that seminal moment. I truly believe that this year, 2025, will go down as that big turning point where money flows out of the United States or away from the United States and into the emerging countries. And these countries just make a breakthrough in terms of the allocation that people typically put in their portfolios, both to the bond and equity markets.
And any specific data points that you're looking forward to over the next week?
Yeah, let's just go through. It's the I've got to just change my month on my Bloomberg and go forward. Yeah, we've got a big data point this coming Friday, which is shown here on the screen. It's the employment report. Remember that the last number wasn't to the liking of Donald Trump, the president, and he's changed the leadership of the agency that's calculating those numbers. So we're expecting, or the consensus is that the unemployment rate will go up by 4.3%. But when people look at these figures, they always focus on the change in non-farm payrolls, which is right at the top there, saying 75,000. Now, just a couple of thoughts on this. There's been so much written about employment data since those last figures. 75,000 compares with a long-term average monthly number of 100,000. Now, a lot of people have said, well, this is not 200,000 or 300,000. We only had those numbers in the past because we were recovering from COVID. So 75,000 is still a good, solid number of new jobs. Secondly, the degree to which this number could come plus or minus is very noisy. So it could be plus or minus 50,000. That's what's called the standard error of these numbers. So ordinarily, you could get 25 or we could get 125. So don't be surprised if you see something in that range. But what the Fed will be looking for is kind of what I call almost abject weakness. They'd like to see, their rate cut would be totally endorsed if this number was a negative figure. It would be totally endorsed if the unemployment rate went up to, say, 4.5%. But there are many factors working here, in particular immigration, the closing of the border, the dragging people off the street and sending them home or somewhere else in the world. That is limiting the number of people who are available for work. So although payrolls may not go up as much as you might expect, the number of jobs available could actually be more substantial. It's just that the US doesn't have people available for work. So many nuances on this number. At the moment, the betting is, a kind of okay figure that still would set the Fed up for that rate cut later in September.
Lovely. Thank you, Gary. Appreciate your time and
Not at
looking
all.
forward to chatting with you next week.
Thank you.
Bye-bye.